Hey there, I'm estate planning attorney Paul Rabelais, and in this video, I'm going to discuss how a married couple's joint living trust could be set up to get split into 3 new trusts upon the death of the first spouse to die. So when a married couple sets up their avoid probate revocable living trust, there are both tax and non-tax factors that drive couples to set up their trust in their estate a certain way. The non-tax factors, probably the most important factors, include decisions like, how do we want to leave our estate to each other? How does the estate or trust get distributed after both of us pass away? Does the inheritance of any beneficiary need to be placed in a subtrust after we die so they don't get their inheritance in a lump sum? And who will be in charge of making sure all of this gets implemented correctly when we die as our executor and our successor trustee? And while I'm not a big fan of having tax laws drive your major estate planning decisions, so my estate planning discussions with people usually start with something like, let's figure out what you want to do with your estate, and then we'll figure out how to best make that work given our current tax structure. It's important, though, how taxes play into leaving an estate, because wise estate tax planning can help you and your family preserve more and keep more in the bloodlines as opposed to leaving to the almighty federal government. Now, estate planning, particularly for those who have accumulated some wealth, typically involves the creation of one or more either testamentary trusts, a trust which your will directs to be created upon your death, or one or more living trust subtrusts, a trust which your living trust directs to be created upon the death of a married person. At this point, I'm going to give you an example. Let's make some assumptions. Let's say Rocky and Adrian are married. Rocky's estate is valued at $10 million. Adrian's estate is valued at $5 million. Perhaps Rocky inherited more, or for some reason his estate is larger than Adrian's. And let's say that Rocky dies in the year 2026, when the estate tax exemption is scheduled to be around $6 million. Let's call it a $6 million exemption in 2026, but it will likely be a bit more than that. During their lifetime, Rocky and Adrian set up their ABC living trust. Rocky dies in 2026. What happens now? Well, the reason the Rocky and Adrian Living Trust is called an ABC Trust is because the trust instrument requires that 3 new subtrusts be established upon the death of the first spouse to die. Know that estate tax planning is typically what requires the ABC Trust scenario. So Rocky dies in 2026. We know that Rocky's portion of their joint trust includes $10 million in assets, and Adrian's portion of their joint trust includes her $5 million of assets. In an ABC trust arrangement, the A trust, which gets created when Rocky dies, shall include all of Adrian's assets, her $5 million. The A trust is also sometimes referred to as the survivor's trust, because it includes all of the assets that are attributed to the surviving spouse when the first spouse dies. So Adrian's $5 million goes into the A trust. The A trust assets are not subject to the 40% estate tax when Rocky dies because they are not part of Rocky's estate. But the A trust assets will be part of Adrian's taxable estate when Adrian dies. Now we have Rocky's $10 million to deal with. So let's talk about the B trust. Rocky dies in 2026. With $10 million in assets and a $6 million estate tax exemption. So $6 million, the amount of Rocky's unused estate tax exemption, goes into the B trust. Rocky uses his estate tax exemption to shield the B trust assets from estate tax. The beneficiaries of this B trust could be Rocky's kids, Rocky's other desired beneficiaries. Maybe income from the B trust gets payable to Adrian after Rocky dies. Maybe Adrian's right to income and principal distributions from the B trust cease if Adrian remarries. The key point here is that the B trust does not have to be set up a certain way to avoid estate tax, because we are saying that Rocky's $6 million exemption shields the B trust assets from estate tax. This B trust is also sometimes referred to as a bypass trust or an exemption trust, because the B trust bypasses estate tax and because Rocky's estate tax exemption shields this exemption trust from the 40% tax. Now, so far, we know that Adrian's portion of the trust assets, which were $5 million, went into the A trust upon Rocky's death, We also know that $6 million of Rocky's $10 million went into the B trust upon Rocky's death. And Rocky's estate fully utilized its $6 million exemption to shield B trust assets from estate tax. And note that these B trust assets and their appreciation will not be part of Adrian's estate when Adrian dies later. The B trust assets will get a step up in capital gains tax basis when Rocky dies, but they will not get another step up in basis when Adrian dies. So enter the C trust. The C trust is for Rocky's assets that exceed the estate tax exemption in effect when Rocky dies. In our example, we said Rocky dies in 2026 when the exemption is $6 million, but Rocky has $10 million. The excess $4 million goes into the C trust. The C trust is set up so that no estate tax is due on C trust assets because it qualifies for what's called Q-tip treatment, or it qualifies for the estate tax marital deduction treatment. Qualifying for this treatment means that Rocky's estate does not have to pay the 40% estate tax on this excess $4 million, but rather those assets will be included in Adrian's estate when she later dies. But to get this special marital deduction treatment, the provisions of the C trust must provide that Adrian get the income from the C trust for the rest of her lifetime, even if she remarries. This C trust is often referred to as the marital deduction trust or the Q-tip trust. And the C trust will provide that when Adrian later dies, remaining C trust assets revert back to Rocky's desired beneficiaries, which I'm sure would include Rocky Jr. So the summary of this often confusing ABC trust arrangement is that when Rocky dies, even though he has a large estate, no estate tax is due. Adrian stays in complete control of her share of the joint trust assets, which are now in the A trust. The C trust includes Rocky's assets that are in excess of the $6 million estate tax exemption. Adrian will get the income for life from the C trust. And the B trust assets are for Rocky's survivors in any method he wants. Since his estate tax exemption will shield these assets from the 40% estate tax, he can leave them any way he wants. So, estate tax was completely avoided when Rocky dies. When Adrian later dies, the A trust and C trust will be included in her estate, and the value of the A trust and the C trust when Adrian dies, combined with the estate tax laws at the time Adrian dies, will determine whether any of the 40% estate tax is due when Adrian later dies. So, once Rocky educated himself and finally understood these concepts, Rocky, in his own way, felt compelled to sing to Adrian the famous Jackson 5 song where Rocky sang, ABC, it's easy as 1, 2, 3, as simple as do, re, mi, ABC, 1, 2, 3, baby you and me girl. Make sure you like and subscribe so that you can keep educating yourself about these important estate planning topics, and have a great day.